Welcome to the weekly video update, where we'll go over the action in the markets for March 21st through March 25th, and then see how things look for March 28th through April 1st. And please excuse my voice if it sounds a little off. I've been battling some real congestion and voice issues over the past week, and I hope we're on the recovery side of all this, but my voice might sound a little different than usual if you watch many of my videos. So let's go back over the week session and see what happened, and then see how things are looking, and then look forward to what we can anticipate in the week ahead. For the week, the S&P did climb 1.8%. It's nothing like what we saw the previous week with a really monster climb, but still, we ended up being up for the week overall. The one thing that's a little bit concerning is there was a real decrease in volume. We started below average on Monday, and then with each successive day, we saw a decrease in volume each day. And I'm not quite sure what to make of that at this point, other than just indecisiveness, as people don't know what to do. Because if we see an up move on low volume, we're a little bit suspicious of that. And the inverse is also true. Well, we had both up and down days in the past week. So, and we saw decreasing volume no matter what happened. So I'm not quite sure, other than people are just unsure about what to do right now. The technicals on the daily charts are starting to show a lot of improvement. In fact, we're pretty much positive across the board. We do have some resistance levels, and we're even showing some overbought signals in some of our indicators. On the weekly charts, we're still more negative. There's some damage that needs to be repaired, but we are seeing some improvements. We're coming up to the end of earnings season at the end of March. And then we're also really battling with inflation and interest rates right now, as prices are just going up very fast. And the Fed coming in and raising interest rates, and there's the debate back and forth, how much, how often, are they going to step in and do something? And then, of course, a lot of the geopolitical concerns, specifically Russia, Ukraine. There's some issues going on in China with lockdowns, and what is that going to do to the overall supply chain in the US? As far as our trend, when we're looking at the ADX on a weekly chart, we are still negative with that trend, but we're showing improvement on the daily charts, and those have to improve first because they're faster. And then finally, the hope is, if you're bullish, that those will then come over into the weekly charts. So what are some notes that we can take away from the past week? The S&P danced above and below its 200-day simple moving average. That's a really important moving average that a lot of investors use. If we're above the 200-day moving average, we're considered to be in a bullish market. If we're below that moving average, we're in a bearish market. Now, it's not quite that simple, but that's kind of the dividing line between the two. There's also been a lot of talk that the FOMC may raise interest rates anywhere from 0.5 to 0.75% at their next meeting. Now, a week or so ago, the idea was 25 basis points at each meeting for a number of times. Well, with some of the economic reports that are coming out, and with inflation being as big of a concern as it is, we're now seeing a lot of the camp say, well, it could be 0.5 to 0.75%. But this is changing all the time. We have all the way until May 4th, until that meeting happens. And there are some charts that I'll show you where this readjusts every day in the percentages. And it can be wildly different between now and when that meeting actually happens. So we just keep an eye on it and then see how things change as we get closer to that meeting. A lot of the inflation sensitive commodities continue to advance. Oil, heating oil, gas, wheat, aluminum, a lot of those things that companies use to make things, well, they're starting to have to pay more for that. And then eventually that'll feed its way over into the consumer so that we see higher prices as well. And then, of course, the situation between Russia and Ukraine, Sometimes we hear some positive things coming out of that, sometimes negative things. It can just go back and forth with the wind, and we don't even know for sure what information we're being told, if we can even trust that or not. There's a lot of disinformation right now. And then, as I stated, China is going through some lockdown phases again because of the virus, and that could affect their economy. If their economy is affected, what's that going to do? Because the US buys a lot of things from China, and with the supply chain issues that we're already having, is that going to feed into even more problems? And then our technicals are improving, but they still have quite a bit of work to do. And I'll show you some charts to go through that. Here is a 10-minute bar chart going back over the last week. And back here is Monday, where we had a bit of a choppy day, but we were down overall on that day. We saw a pretty nice advance on Tuesday, only to have things then decline on Wednesday. But then Thursday, things seemed to kind of turn around a bit, and we had a really solid up day. And then Friday was looking good too. We started off higher. Interest rates have really been rising, so we saw things fall back, but we were able to recoup those losses and end at the high for the day and also the high for the week. So that will help some of our weekly charts to improve. For the week, the Dow was up just 0.3%. The NASDAQ was up 2%. It had been getting hit a lot harder. Well, it bounced back a little bit more in the previous week. The S&P was up 1.8%. And the small caps with the Russell 2000, they were actually down 0.4% for the week. So this is how things look just over the past week from March 18th through the 25th, where the NASDAQ 100 was up 2.33%. And this is measured a little bit different, so the numbers are going to vary. Then both the NASDAQ 100 and the NASDAQ, they performed the best over the last 7 calendar days. Then you had the S&P right here in pink. That's what we focus on. NYSE, the Dow was also up a little bit. Mid caps were up a little bit, but then small caps actually saw a decline on the week. Now, this next part is I go to a website to find out this information, and it doesn't change all that often, but it's currentmarketvaluation.com, and here's the web address if you want to go there. I just take a big screenshot of their overall indicators that they use, and they've developed a model that has, I believe, 6 or 7 different parts, and then they put that together to come up with one conclusion. And they're pretty much basing things now that we're more fairly valued. And nothing has really changed since the last time I talked about this. I just wanted to include it in a little different way, where here's the yield curve itself. We've really seen a decline in that, and I'll address more of that. And I'm addressing that also in the daily videos, because we're seeing a real drop right now. And a lot of people are going, ooh, recession. Well, we should get some answers to that in the coming week, where one of the GDP reports is going to be coming out later in the week. There's also a thing called the Buffett indicator. And when it's really high up in the red area, that means it's extremely overvalued. Well, we've come back down into the yellow area, so we're now overvalued. The PE ratio is overvalued. It had been a lot higher in the red area. Now it's down in the yellow area. Interest rates, they're so low that it's, when you compare them with what the stock market is doing, they come up with a fairly valued indication here. Margin debt, which really started to spike at the end of 2021, has really been declining. And you see this number just drop drastically when we have a bit of a downturn, because people are using borrowed money to buy into the markets, and they have to pay all that money back. And so they're more inclined to sell quicker, because not only are they losing on their investment, they're losing their ability to pay back what they borrowed. And then the mean reversion, which the mean is just what is the mean price over a period of time, and how far away are we now away from that longer term measurement of price. we had been very extreme, but with the declines that we've seen recently, we've come back down to just an overvalued level. So when you look at the stock market aspects of this, we're still overvalued. When you take the bond market and margin debt and things like that into consideration, this core valuation model is saying things are fairly valued right now, right in about the middle, not too expensive, not too cheap. I use a little bit different of interpretation, but I still find this to be a pretty helpful tool. As far as the different sectors, how they performed over the last week, energy came in number one. Then we have some of the value plays materials. Utilities have been doing quite well, and they were up in the past week. Tech rebounded pretty good. There's only one sector that's really been suffering a lot lately, and that's the healthcare sector. All the other sectors for the week, there's 11 sectors in the S&P 500. Well, 10 out of the 11 were up, and the healthcare sector was down. Not too much, but still down on the week. This is how the different sectors performed just in the past week, where energy has been doing really well. And then we have some of the value plays, materials, and communications kind of got hit pretty hard at different points during the week. Tech, which is trying to make a bit of a comeback. We have financials and discretionary, which were most flat over the last 5 trading days. And then healthcare is the one that's really been getting hit the most, at least recently. So how about sentiment? How are people feeling about things? Every week, there's the American Association of Individual Investors that they do a survey, and they ask them, and I'm a member of this, and I take part in this survey. How are you feeling about the next week? Are you bullish or are you bearish? Well, we saw a really extreme negative reading a week ago, long about the time we started to go higher, because individual investors tend to react to what's already happening rather than getting ahead of the curve and trying to proact and be ready for things before they happen. And it's an emotional roller coaster when the market's going up, and individual investors are feeling good. When the market's going down, individual investors are feeling bad. Well, we're able to climb back up, and we're above this red line. Below this red line is an extreme reading. Well, when we get back up into this area, we're more in neutral territory, but we're still kind of near the bottom right now. Another chart that I updated a little bit is the RIDEX bear to bull ratio. Are people getting into bearish mutual funds that RIDEX offers? If so, then this indicator really spikes up. Or are they favoring bullish mutual funds? If that's the case, then this indicator really goes lower. Well, right about the time we hit what appears to be a bottom in the market, at least a short-term bottom, we really spiked up. Well, over the past week, now that things are starting to recuperate, excuse me, I'm still dealing with a cough, we have seen this come back down, and it's more in a neutral reading at the current time. And you can compare it with the S&P, and you see where there are really large spikes. A lot of times this has signaled some kind of a market bottom at some point or another, kind of a critical mass type situation, because a lot of individual investors, they have other jobs. They might look at the weekend or look at things on the weekend, or maybe in the evenings, they make their decisions, but their lives are focused in a different direction, and they see what's going on, and they tend to react to it. Ooh, I better get out of that bullish mutual fund and get into a bearish one. And so we can follow their emotions, and then when those emotions get extreme, we can use that as a contrary indicator. Another thing to look at is on Friday, we had the University of Michigan consumer sentiment reading come out, and it's showing that people are just not happy right now. This was the final reading. We came out with the preliminary reading 2 weeks ago. That's this blue line here. When the blue line is trending higher, that means people are feeling good or better about things. When this blue line is declining, people are not feeling so good about things. In a good, healthy environment, you'll see this red line, which is the yield, the interest rate on the 2-year. If both of these are going up, that's usually a pretty healthy environment. Well, we're seeing them going in opposite directions. We're seeing a real spike in interest rates, and we're seeing a real decline in how people are feeling about things. And then down at the bottom, I just have a measurement between the two where we're spiking up. I'm not really sure what's going to happen to change this picture, either make people happy or interest rates are going to have to come down. And neither one of those seem like really viable options at this point. So we just kind of have to watch this and then use it, know that it's going on, and then realize that there's kind of a real negativity going on right now. Another thing is the VIX. This measures fear. As this indicator goes up, that means there's more and more fear. As it comes down, that means fear is decreasing. On the top, I have just a line chart which measures the closing basis, the closing value of the VIX. Down on the bottom, I have a bar, and that shows us the open, high, low, close for the week. Well, we saw, and we've been seeing over the last couple of weeks, a decrease in fear. We're still kind of at an extreme level. When we drop below this blue line, that's when we're getting more to a complacent or non-fearful environment. So we want to keep an eye on this, both on the daily charts and here on the weekly charts. Another thing that's really not telling us too much right now, it's called the ulcer index. As there's more and more fear in the market, this indicator goes up. Well, we've been advancing and it increased a little bit, but we're seeing this really drop back a lot on the daily chart right now. So this is lagging just a little bit. Then there's CNN Money comes out with something called the Fear and Greed Index, and this is measured every day. This is Friday's reading, where we're getting back up to more of a neutral feeling right now. We had been getting over into the extreme fear as prices kept falling. And again, we can use that as a contrary indicator. And then here is a chart. This is showing when we were reading things a lot lower just a few weeks back. Well, since the market has been advancing, this indicator has been advancing, and we're more in neutral territory. When it looks like we're getting to a top, this reading will be up at 80 or above. Another thing to look at is the Chicago Fed National Financial Conditions Index. They don't believe in short names for some of these charts. Basically, to look at this chart, if we're below this black line, things are going good. If we get above this black line, things are not going very good. And you can see historically what has happened. The spike that we saw back in 2020, that was the COVID plunge. 2008, 2009, that was the whole financial meltdown. We didn't really see much of a reading back in 2000 in here, but then in the 70s and 80s, man, we had lots of problems back then. And this indicator was really spiking up. Well, where are we at right now? Yeah, we are increasing, but we're still well below this black line. So nobody's really freaking out, at least according to this chart, about the economic conditions. Another chart is risky loans versus not so risky loans. When this really spikes up, that means that a lot of the risky loans are in danger of defaulting. And we can see how that spiked up back in 2020, how it spiked up in 2008. It spiked up a little bit back after the dot-com boom and bust. Well, where are we at right now? It's not really freaking out at this point. Now, this could change at any time, and some of this information can be a bit lagging before it actually makes its way onto the chart, and then the chart has to be updated as well. But this is not really showing a lot of concern right now. Another thing to watch is this is a chart of the active money managers for mutual funds. They actually try to find good investments, and they try to find good growth investments when the market is really going up, and they try to find more value investments when the market is going down. Well, growth is considered riskier. It's risk versus reward. If you get into a growth stock, yeah, it may not perform, but if it does perform, it's going to really perform well for you. Well, this just measures how much risk are these money managers willing to take. At the beginning of 2022, it really started to trail off as the market was going down. They were getting into less and less risk exposure. Well, after the bottom that we had, we're starting to see these money managers getting more into riskier assets, which could help the growth phase of the stock market. But this is like an oscillator too. When it gets above 100, that's pretty extreme. And usually when it drops down, it doesn't drop down below 40 very often. But we just keep an eye on this and then gauge it with other indicators to say, okay, I think we're getting extremely negative. And that's really what happened here. Another thing, and this will change it changes every day, but it'll be a lot different as different economic reports come out. Right now, the market is suggesting that after the Fed meeting on May 4th, the interest rates will be at 3/4 to a full percent. And so that's 50 basis points higher than where they're at right now. So that kind of changes the scenario that the Fed had been coming out with, saying we're just going to do 25 basis points at each meeting. Well, now the camp is kind of getting towards, at least at the next meeting, they may bump it up another 50 basis points, which will shoot it up to 75 basis points. And then this is a historical chart just showing how these things change over a period of time. I don't pay as much attention to this right now because we have a long way to go before this meeting is actually going to happen. Then looking out even further, this is what the market is suggesting for the June meeting. And they're saying in June, they're giving it a 66.2% chance right now that interest rates will be 1.25 to 1.5 at that point. That's a full percentage point above where we're at as I record this. What's that going to do to the economy? What's that going to do to borrowing for a mortgage or for a car or in your credit cards? And because this is just the initial reading, then it gets bumped all the way through the economy. I wish it got bumped through to savings accounts and CDs, but it just doesn't seem to do that as quickly. But the Fed is supposed to do what the market tells it to do. And right now, but this could change at any time. But right now we're looking at interest rates really being increased. Another thing that's happening, and I've pointed this out in many videos, is it seems like the Fed is raising interest rates. That's to slow inflation down. Well, at the same time, they continue to add to their balance sheet through quantitative easing. So that's to speed things up. And so it's like the Fed has their foot on the gas and on the brakes at the same time. Well, they said that they're going to start tapering off. And when they do start doing that, means getting rid of the bonds that they've been buying. Well, then we should see this start to decline, kind of like we were seeing back in 2018 and into 2019, up until the COVID plunge. So we want to just keep an eye on this one as well. And then another thing to watch for on an inflation scenario is fertilizer. Farmers have to have that to grow things. And we have been really spiking up with fertilizer. And look what happened before. When we had a real spike in fertilizer prices, that was right before the big financial meltdown that we had. And that's about as far back as this chart goes. This is a Bloomberg chart that you can freely get on the internet. Another thing is a company called Decision Point, and a lot of the basis for the charts that I use came from them. They have some signals just showing in the short term, they're looking more positive. Intermediate term is neutral to down, but they're suggesting that the long-term trend is still positive. Looking at breadth on a weekly basis, we saw some advance for the week. When this blue line is above the red line, that means we're showing healthy advancing based on the number of stocks that are going up. And then this bottom measurement is volume, where it had really been going down. Well, we're starting to come back up to the moving average now. So it's showing some improvement. Another thing is the advanced decline ratio. We look at both this red line and blue line. When they're both going higher, that's healthy. And when they're above zero, that's more positive. When they drop below zero, that is more negative. Another thing are the number of new highs and new lows. We saw a real advance in new highs over the past week, and that's helped our 10-day moving average to improve and remain above the zero line. So things are improving internally. Now we just need to see it more on a price basis. Another thing we measure is accumulation, which is buying, versus distribution, which is selling. And overall, the blue line is just slightly above the moving average right now. As far as our trend, this is a weekly chart of the ADX. And this is showing with the red line on top, that means that we're negative. And when this line is going higher, and especially when it's above 20, that means we are in a trend. Now, this trend could be weakening because we've been seeing some advances, but right now we are negative. And we're seeing it's still negative on the daily charts, but the ADX moves a lot faster and could be improving quicker. But right now, we kind of have to default saying that this is a negative trend right now. Another thing that I look at is called the Arun. And again, it's looking a lot more positive on the daily chart. When this indicator, when the green pegs all the way to the top, that means that buyers are in control of the market. When the red line spikes up, that means that sellers are in control. And then down below, you just have a calculation which compares the two. When this oscillator is below zero, that's negative. That means there's more selling than buying. Well, we flattened out from the previous week. We're looking a lot better daily, but here we're still showing a decrease in buying, a little bit of a decrease in selling, but it's still negative overall. If these lines cross back over with the green line crossing back over the red, that's when this indicator will go back above zero. Another thing is called the mass index, and we're just waiting to see what will happen here. This is a two-part signal. When it goes above 27, that's part one. When this indicator drops down to 26.5, that's signal number two. And it doesn't tell you the direction that things will go. It just means that there could be some kind of a big move happening. And then we use other tools to try to help us determine what the direction will be. Looking at some long-term charts, these are the pivots based on the weekly chart. And it's positive. Anytime we're above this P, that's the pivot, that's considered positive. If we're below it, that's considered negative. We do have different levels of resistance and support, but we're not really in danger of hitting those levels at this time. And then down at the bottom, you can see where volume has really dropped down below average. This is just a basic chart looking at the S&P 500 with a 200-day moving average. And this is a daily chart. And I wanted to show that because we're looking a little bit more positive on a daily basis. We're actually above the moving average. Then looking at a weekly chart where I have a 13-period moving average with a 50-period moving average, we're showing some improvement with the bars, but look, we're coming down with a potential death cross with these moving averages. Then another thing is the bullish percent index. It saw a nice advance over the past couple of weeks, and we're getting close to an extreme positive reading. So we're seeing some internal strength in the S&P. We just need, especially the moving average based indicators that we use, because they lag, they're slow. So they're not going to pick up a lot of the improvements. It's going to take them longer to do that. Then the Chaikin oscillator, after giving us an extreme negative reading, is starting to bounce back and look more positive. And this is just a longer term view of that same chart. And feel free to pause this video if you want to study any of these charts more in depth. I know I kind of go through them pretty quickly. Another thing is called the Chaikin money flow. It's still negative, but showing improvement. And then the force index, it was ever so slightly positive a week ago. Well, it's showing some more follow through after this week. This is the McClellan oscillator. This could be a little bit concerning. It just shows us that prices have really shot up pretty far, pretty fast, and we're getting an extreme reading right now with this indicator. And then another thing that goes hand in hand with that is the summation index. Here it's based on price. And if we could get above zero, that would be more positive, where the bottom is based on volume, and that is looking more positive right now. So again, we're seeing what potentially could be some internal strength. One thing that, and I say this every time, but I still show this chart, these are oscillators that are supposed to study momentum. And you could say, oh man, look at this, the end of the world is coming. Well, as we go higher in prices, the lower numbers down here get taken out of the calculation, and these oscillators can't help but roll over and look like they're dying. So I don't read a lot into that, and be a little suspicious if you do listen to people that do say, oh, look at this, man, market, we're end of the world's coming right now, and this is why right here. Well, it has to do with how they're calculated. Another thing is the PMO. This is a price momentum oscillator. Again, I'm not all that crazy about what it's doing, but I still look at some of the other measurements where based on price, we're showing some improvement, and based on volume, we're also showing some improvement. Another study are what are the PMOs over the last week that are actually rising. That's starting to get extreme positive. What inside the S&P are giving buy signals. That's starting to get extreme positive. And then what are those components in the S&P 500 that are actually above zero? And that is advancing. So this is suggesting we might see a little bit of a pullback. Okay, doesn't mean that's going to happen, but we're starting to get extreme positive with some of our indicators. And we're seeing the same thing on the daily charts. A weekly RSI is above 50 and advancing. That is positive. Another thing is called special K, where it's been declining ever so slightly. This moves a lot slower, but it's still above the moving average. Then we have a thing called the short-term oscillator. It's still positive based on price, but declined a little bit, and is still positive based on volume, but also ticked down slightly over the last week. Williams percent R is above 50 and advancing, so that's positive. The Stoke RSI above 0.5, which is kind of like 50 and advancing. Then we have another thing called the vortex, and when the red line is on top, that means selling is in control. When the green line is on the bottom, that means buying is not as strong. Well, we're seeing some improvement with this indicator, but it's still negative overall. Then another one is called the ultimate oscillator. We are above 50 and advancing, so that is positive. And then another thing called the money flow index. It hasn't got back up to 50 yet, but after giving us an extreme negative reading, is showing some improvement. Some of the different charts, Heiken Ashi for the last 2 weeks, it's redrawing things and it's looking more positive. Then a Kegi chart turned black. It had been red. That's negative. Well, when it turns back to black, that is more positive. The Renko, it hasn't really picked up the price advances that we're seeing because we've been in a lot of these price levels before. And so it needs to see more upward action before this chart looks more positive. And then another thing called equivolume with the ease of movement indicator. Over the last week, it's really shown much of an improvement. And then over the last 14 weeks, it's showing some improvement as well. Point and figure on a weekly chart, we were able to draw in a new X. And we're seeing the same signal on the daily charts, a double top breakout possibility here. And that could be positive, but we need to see follow through action for this positive signal to be validated. Three-line break is also showing some improvement recently. Our different trading systems. The Elder system, we had a green bar, which is positive a week ago. Well, it stayed green for the past week. And then SAR, this is negative. When the dots are on top, that's negative. When the dots are on bottom, that is positive. So we're getting kind of a mixed picture in the weekly charts right now. Looking at all the stocks, here's a weekly chart of the S&P, which is showing a bit of a breakout, where mid caps are still going more sideways and small caps are also going more sideways. Then looking at the all stocks, and this includes US and international stocks as well, we're coming right back up to the 13 period moving average, but we saw a recent death cross. Doesn't mean it has to stay that way. It just means that we're going to have to fight to get this chart to look more positive. Mid caps also dealing with a recent death cross and looking more sideways. And then small caps, recent death cross, looking more sideways. The Dow, it's kind of at a critical point. It's dealing with its 200-day moving average, and that's a big deal because that's what everybody talks about. Well, we're looking at a potential death cross here, and we're butting into these moving averages, which are acting as resistance. The NASDAQ, it's bouncing back a little bit better, but still it went down a lot heftier. And so it has a lot more damage to repair if prices are going to go higher. NASDAQ 100, kind of the same thing, coming back up to the moving average after seeing a pretty significant decline. NYSE, more broad-based, it actually is showing a bit of a breakout and is going above the moving averages. And the Wilshire is dealing with some overhead resistance with its 50-period moving average. The FANG stocks, these are the big tech stocks, Facebook, Amazon, Netflix, Google. They've really been getting hard since the beginning of the year, but they were up 3 1/3% over the past week. They were able to regain the 13-period moving average, but we still have to get up to the 50-period moving average. ARK, this is the Kathy Wood ETF that she manages. It was down 1.92% on the week and is in a pretty solid downtrend overall. And then this is dynamic software. These are the big software companies. They've really been showing some weakness with a declining moving average. So a lot is going to have to be done for this chart to look better. Broad market, looking at the CRB index, and this is what I'm using most now to gauge inflation. Well, we've just been in a solid weekly uptrend ever since the COVID lows that were hit. And gold, it's trying to break out, but every time it looks like it's going to break out, it then falls back. So we're kind of going more sideways right now. And silver, kind of the same thing. It looked like it was getting ready to break out. It still had some previous resistance and previous price levels to deal with, but then it fell back, even though it was up 2% for the week. Oil spiking up to 130, fell back. Well, we've come back up to 113.90. The dollar's been hanging in there pretty well. It's in a weekly uptrend and is climbing ever so slightly, which then means that the euro is coming down because those are the two big currencies these days. Looking at some relative studies, when you want to compare stocks with bonds, this is a weekly chart. And if you had got into bonds instead of stocks, this is the IEF, which is a bond ETF against the SPY. Bonds based on prices have considerably underperformed the stock market over the last few years. Another measure, and this is a monthly chart that I like to look at every week. This is also gauging how are stocks doing against bonds. Well, this is showing that stocks have been greatly outperforming bonds, and we actually have had kind of a recent breakout here as well. Then this is an intermarket analysis daily chart where I just go back 1 year, and this just shows how oil has just gone to the moon. The S&P is showing some improvement. Gold looked like it was breaking out only to come back. The dollar's been holding up pretty well, but bonds based on price have really been declining. Then here's looking at gold versus the US dollar. Well, it looked like gold was trying to break out here. And the dollar, and that's the interesting thing, is we've seen a lot of days where gold and the dollar will go in the same direction at the same time, where a lot of times they end up going in opposite directions of each other. Well, this breakout against the US dollar doesn't look like it's happening, at least yet. Then gold against the S&P 500, it looked like it was breaking out only to be coming back down. Then this is the low volatility stocks in the S&P 500, the ones that don't gyrate as much. Well, when we get more defensive, when we think we're headed for a bear market, a lot of people will get into these kinds of stocks instead of just being exposed to the entire S&P 500. Well, over the last year, you would have really underperformed last couple of years. Well, we're seeing a bit of a breakout right now, but we were up slightly on the week, but it's also starting to pull back. But we're still above the moving average right now. And then looking at growth versus value, it just shows overall for the last number of years, growth has led the way higher. Well, now we're seeing a lot of recent weakness in growth, although it is trying to bounce back. And then the NASDAQ 100 against the S&P 500, heavy tech stocks in the NASDAQ 100, we're seeing recent weakness trying to bounce. And then the S&P 100, those are the 100 biggest stocks compared to the rest of the S&P 500. It's kind of been shooting more sideways, but over the last couple of weeks has been showing some improvement. So what are we looking for over the next week? The long-term trend might be improving, especially on the daily chart. If we can stay above the 200-day moving average, then the improvement scenario is valid. If we drop below that and then stay below that, then we'll say the long-term trend is weakening. In the coming week, some of the reports that will be released. On Tuesday is consumer confidence. That kind of goes hand in hand with consumer sentiment. Then on Wednesday is another release of GDP, and that could be pretty influential. Then on Thursday, we have personal income and spending, the PCE, and the Chicago Purchasing Managers Index. Friday is probably the biggest economic report of the month. It'll be April 1st, and we have the whole employment situation report coming out, as well as the Institute of Supply Management Manufacturing Index. The big one will be the employment report, and then a continuation of the geopolitical concerns that I've already mentioned. So what I try to do is, remember, looking at the market, only three things can happen on a time scale here. Prices can go up from where they're at right now, they can go down from where they're at right now, or they can stay the same. And so I try to come up with a scenario for each possible outcome and then say, okay, some of these scenarios turn out to be silly and they really don't apply to our situation. Others, we can look at this and it just lets us think about the different things going on. Because as I teach in my classes, the things that really can hamper investing and trading the most is to be caught off guard. When you don't see something coming and you're not prepared for it, you get in low thinking that you're going to buy low, sell high. Well, what happens if you go sideways? What happens if you decline? You need to play all of those scenarios out before you even get into a trade or an investment, and then adjust that as time goes by. And that helps lead to more consistent success. Okay, so what is my current scenario if prices are going to go down? One of the things I've been looking at is before the Fed came out and when we were really establishing that bottom, we were in a negative trend at that point. When we started to bounce up out of that, were we going to eventually revert back to that trend that was negative? Are we just bouncing to wear off the extreme pessimism? Well, we're getting further and further away from that base. So this is becoming a lesser likely scenario, least likely scenario. Now, another scenario for B is that if we see a bit of a pullback, it doesn't necessarily mean there'll be a reverse in the trend, but it's just because we're showing some overbought signals on the daily charts. And then you also saw some on the weekly charts. And we also have some overhead resistance. So again, that seems like a more likely scenario to me if prices go lower. Okay, what's our scenario if prices go up? Are we coming up out of a base? Yeah, I think enough time has passed now, and we've seen a big enough of an advance so that we can say that that was a base. Our oscillators are positive, especially on the daily charts. We have moving averages that when we fall, sometimes they help provide support. Now they're also providing some resistance as we try to go, and we are exceeding some previous highs that were set earlier. So that could be more positive. And then the least likely scenario that I see for right now, which may become more viable if we see a real decrease in volume, is more of a sideways pattern. When the ADX drops below 20 and we're just kind of trending sideways, instead of seeing 1, 2, 3% up and down days, we're seeing a half or a quarter of a percent or 0.75% advance or decline. Price movement will really slow down and we get more into a trendless environment. That's when you might look at doing things more like covered call writing or selling credit spreads. Now, I know you're not going to bring in as much because when we're in highly volatile markets, when we're dancing all over, that's when you're going to generate more income from those things. But you have to go with the risk versus reward scenario. Yeah, you might bring in more money, but you might be at more risk at the same time. Would you rather bring in less money and have more probability of you not running into some serious trouble with some of those positions? Again, you have to answer that for yourself. I have the way that I do things, but each person needs to decide their comfort level. But the big thing I want to stress with this is we need all three of these scenarios going through our head all the time. We might have just a screaming up day, but we're still keeping scenario 2 and 3, I'm sorry, scenario 1 and 3 on the back burner because things can change at any time and we don't want to get caught by surprise. So thank you very much. I hope you have a wonderful week. Please feel free to check out some of the daily videos that I post. I also post what's called a daily snapshot video, which I try to keep around 10 minutes, where I don't show a lot of charts. I just go over the major highlights and the points that I bring out on the slides, because I know some of my daily videos can be 40, 45, 50 minutes long, and people are busy or people aren't as interested to watch that every day. So check out some of those shorter videos, and then after watching that, see if you want to go watch the longer version of the daily videos. So again, have a great week, and I will talk to you next week.